Okay, good morning, everybody. Okay, we'll restart the webinar because of the technical difficulties just now. Okay, I'm Joshua Tan, the Head of Research. Okay, today we'll be going through our usual take on the markets on a short-term and long-term basis, and then we'll be talking about oil service sector. Okay, right now, in everyone's mind is probably the U.S. debt ceiling. Tomorrow, are we going to wake up to a partial shutdown of the U.S. government? This is quite possible if we don't have an 11th hour deal tonight. And if we don't have a deal by the 17th of October, the U.S. Treasury will run out of money. And if the debt ceiling is not raised, and then we will have a default. So if that happens, we could literally have financial market chaos. Okay, if we don't have a deal by the 17th of October. And why are markets so blasé? I think if we look at the charts for the past 2 weeks, there has not been much of not much pricing of this event into the markets. Although there's some selling today, maybe we're starting to wake up to it. Okay, so we think that could be because of two quick facts, really. We've been here 78 times before since 1960. Okay, since 1960, 78 times the Congress has raised the debt ceiling at the 11th hour to avoid default, 49 times under Republican House and 29 times under Democrats. So it's pretty neutral, whoever's in control. But at the end of, by the 11th hour, we usually get a deal. So are we going to get a deal again tonight? Maybe it's the 79th time. Another quick fact is that if that fails, the president could, in theory, unilaterally raise the debt ceiling under the 14th Amendment, Section 4, which states that the validity of public debt of the United States, authorized by law, including debt payments incurred for pensions and bounties for services suppressing insurrection or rebellion, shall not be questioned. So the president could state that the republic is under threat because the debt ceiling was not raised by Congress, and to preserve the republic from an economic meltdown, perhaps he could actually unilaterally raise the debt ceiling himself, although the president has said that that is, of course, his least preferred option. So could we have a black swan event on the 17th? I think everyone seems to be taking for granted that a last-minute deal will be done. It's very difficult for us to advise either way, whether you should trim portfolios or to totally ignore this and stay long. I think, dear clients, you should manage your own risk. Okay, so I just want to reiterate that we don't have a deal by the 17th of October. We really could have massive chaos in the global economy. Okay, but if we do have a deal by then, it's really back to the same old, same old. Macro conditions suggest that it's still an overweight stocks environment. G3 plus China economies are improving. Earnings in China is rebounding strongly. Earnings in Singapore is actually turning around. Overweight commodities, also based on the same economic outlook. We see improvement in the major economies. Although I think Kenneth will show you later that there has been a failed breakout in commodities. We're not giving up on this one yet, but I think we should watch the charts. We're underweight gold because U.S. growth outlook's improving, trade deficit narrowing, budget deficit narrowing. Okay, on gold, I suppose if we do have financial market chaos, then gold will soar. But if we don't, then I think it'll continue its downtrend. Also an underweight on U.S. Treasuries because the growth outlook is improving. So we've gone through these points many times before in previous webinars, and we won't go through them in detail again today, except to reiterate our position. And I'll pass you on to Kenneth for the short-term outlook.
Hi, it's Kenneth. We're going to give you the market outlook again. So good morning again, and thanks for hanging on. Okay, so just to reiterate what I've been talking about, this is the short-term market outlook. So essentially, the world equities ex-US continues to have its breakout. Gold is in the midst of short-term consolidation. Okay, S&P 500 looks to continue a short-term correction. I think we guided this from last week. The GSCI commodities, okay, we need to claim a the breakout point to stay bullish. So right now it's failed the breakout. STI may be midway in short-term correction. We guided this last week as well. Okay, so here's the FTSE Oilwell ex-US. The reason why for this chart I just took away US because we all know that US is the strongest indices out there right now, and I wanted to see a gauge of the rest of the strength ex the US, and we can see essentially that without the US, the strength is strong. We have a multi-year breakout, and we've been staying above it. Note that price has to remain above this blue zone before you can actually remain bullish, but it looks encouraging so far. So there is strength outside of the US. A great part of this strength is attributable to the Eurozone, the German markets in particular. Okay, this breakout is on relatively good strength compared to the S&P. Okay, for gold, we maintain our stance, bearish long term, but short term indecisive. We've had a short surge up here. We mentioned before that this surge here from June onwards, it was not accompanied by much excitement from gold miners. Hence, we believe that this move here is a little weak, and at the most, it should only be one more move up. And if there is one more move up, then this is a great place to sell your gold or to short your gold. But at the same time, we must look at the chart to see whether it will actually just break down from here. Okay. If you go deeper, the price is in a trading range now, so it's pretty easy to see where it's going to break out from. If it breaks out from 1400, it's probably going to have a target of 1550 here. All right. I expect this to be heavy resistance at here. 1550. If it just breaks down at 1300, then we expect downside from here. Okay, the other indicators don't really show any unusual strength, so hence I believe that this is just simply a short-term up move, and this is not a start of some massive bull market. Okay, so that's for gold. Okay, for the S&P, all right, since the 9th of September, we've been saying that we have a short-term correction to proven otherwise. Okay, but let's look at the industrial sector first. So 3 weeks ago, this was the pattern, and we guided that because of 3 big technical reasons, a retracement to 45.5 to 46 is possible here. Right, this is what we guided 3 weeks ago. Okay, the reason why we look at the industrial sector is because the industrial sector is the present leading sector in the S&P. So if you can tell where the leading sector is going, that will probably the probability that the S&P will follow is extremely high. Okay, so since then you can see that price has been coming down and down again, and I believe that the most likely setup. Of course, I can't be 100% correct on this all the time, but the most likely setup is that this would definitely come down to this range first, 46, okay, before deciding to do other things. All right. So if that's true, then this will corroborate basically a continued move down to the S&P. So on the 20th of September, we also said that the S&P, I put this down, I guided 2 weeks ago that the probable downside target is in the red zone, which is here. Okay, so this is the chart 2 weeks ago. And where are we now? Okay, we're here now. Okay, so we actually are in the red zone right now. And so are we going to bounce from here? Well, because of the weakness I saw in industrials, I think that this will probably come down even more to the bottom of this red range. So we need to see the price come down here before we decide what to do. So S&P is also in a halfway through, I think halfway through its short correction. Sector glances, okay, this is just for your own reference, but essentially the sequence of the relative strength turning up for all the different sectors is the same as before. Okay, here's just to reiterate that industrials is the leading sector, okay, in the S&P. It is the leading sector. That's why we like to look at the industrial to see where the S&P is going. At the same time, you notice that materials now has entered into leadership. So we're getting closer into our sector. We're moving further on to a sector rotation. Energy is still not leading yet. Okay, so that leads us to believe that that based on this chart here, that the market top is not here yet, because the market top occurs when energy is clearly leading, and energy is not leading yet, but we're probably close. So there is still some move. We're still in a bull market as of now, at least where the evidence looks at, barring any black swan event, that is. Intermarket relationships, okay. Here's a 3-year charts. Okay, we all know the story. So bonds have been on the bull market for quite some time, multi-year, 6-7 years. Recently, last year, we had a big sign of weakness. It threatened to break this long-term trend line, but since it has basically it's a false breakout, it's bounced out. Okay, same for commodities. Commodities had a false breakout, and since then it's retraced back into its consolidation pattern. Okay, stocks remain bullish. Okay, let's look. So what does that mean? Well, let's look at the commodities chart itself. So we know that this is the GSCI index fund. Okay, and we saw last month that price had broken out. Okay, on high volume. Sorry, this is the volume bar here. This oval is supposed to be on this volume bar. So, but since then, it has retraced back into its consolidation pattern. Okay, on lighter volume compared to this breakout. Okay, so as a trade, the trade still stands. Okay, that if you traded this, the target price is still 37 and the cut loss is 32. However, we're not going to give up on the bullish nature of commodities in terms of long term. So this is still a consolidation pattern. Okay, but one thing to note that now you have two very significant supports. The first support is the massive consolidation and breakout support, as denoted by this line here. And the second one is this. As you can see, I can actually draw this. I can actually extend this trend line to about here even. This is actually the uptrend line for the whole triangle pattern that you see here. So this is your final support. Okay, so if price breaks through this bottom support, then we have to reassess our call. But at this point, the price is soon going to hit off two strong supports, and we need to see how it interacts on these supports. Okay, we need to see it bounce off from these supports. Okay. All service sector. Okay, so we have a breakout followed by a indecision candle and a bearish candle. So it wouldn't surprise me to see a short correction. Okay, but the trade is still on. It is still bullish. You still have a target price of 52 and a cut loss price of 44. This is just a technical target. Okay, and note by the time this price comes down here, you will have two supports again, and we need to see a big bounce off here. So it's actually very easy to see if it breaks through that, right? You just have the cut loss. It's a very easy trade to make. Okay, but at this point we are still long-term bullish. Okay, so here's where we think we are, basically on where the business cycle is concerned. Treasuries, okay, it has reclaimed past its most immediate resistance line over here. Hence, this is what I put down last week. I said if price breaks out of 125, it implies further upside. Okay, and the upside target is 126 to 126.5. Okay, so the most probable thing is that the price can, after a retracement, maybe can still make its way here, barring any black swan event. Okay, and then from here we need to observe to see whether it will resume its bearishness or not. The TNX is just the yield, so I'm just showing you this so you can see that the pattern is the trade is very much the same. In this case, it's broken through its resistance, and it's probably likely going to go to 25 here. Same for the TBT. So TBT here, we've broken through the green zone, right? I already put this down a couple of weeks ago. The breakage of the zone triggers a short-term cycle down, so the zone has been broken. So it's probably going to hit 72. It has a chance of hitting 72 to 73. Okay, before bouncing. Okay, China play. All right, so China, since its breakout, has retraced and is almost back at this blue support zone. Okay, so just to reiterate, we had a breakout from this ascending triangle pattern. All right, then we had a semi-bearish cloud cover, right? And I mentioned that there could be a correction. All right, and then but because of improving macro in China, okay, we believe a longer move up is still in the cards. And I did mention this, a retracement back to the breakout point of 2300 is a good buying opportunity, and we are slowly getting there. So if price actually comes down to around here, the blue zone, or even closer to 2300 here, which is basically the launching of the triangle pattern here, right? That this would be a good time, if it doesn't break, that is a good entry point. Okay, this is for China. For Singapore, same thing from last week. We mentioned that Okay, just reiterate. 1 month ago, we mentioned that there was most likely going to be a correction. Most likely, retracement was in the blue zone here. Price retracement to the blue spot zone should be seen as a good buying opportunity. Since then, price has hit the mid-range of the blue zone and has gone up. So if you took the trade, you would have made some money. And where we are today is as follows, like this. So we have this pregnant pattern, as we call it. Okay, and that's short-term bearish. Sorry, this is short-term bearish. So the thesis is the same. We are longer-term bullish because of macroeconomic reasons, but short-term might have a pullback. If you look deep into the STI on a daily basis, this is what we had last week, and I mentioned that most likely scenario pullback until 3200. That's what I mentioned. Okay, and sure enough, we hit that last week. We went past 3200 right here. So where are we going to? What's going to happen now? Well, because there's a breakthrough, this gap here, that leads me to say that it's most likely going to hit the bottom gap as well. If this gap doesn't hold, it's probably going to go to the bottom gap. So short term, I think that's where we're going, to fill this bottom gap over here. And we need to see what happens in the market at that point, whether it's going to retrace up or not. But we are still biased to the upside because of improving macroeconomics. Okay, that's for STI. So to reiterate, on the long term, we are overweight equities, especially in the materials and energy sector. We are long China. We are overweight industrial commodities. Long-term oil service sector, overweight that. We are underweight gold on the longer term and underweight treasuries on the longer term. But on the short term, they are essentially pullbacks or midway of pullbacks on most of these asset classes. Hence, we can be a bit more cautious at this point in time, especially when there's a potential black swan event coming this month. So let's be cautious. Okay, and now I'm gonna leave you with Yong Kai, who's gonna talk to us about the U.S. oil sector and equipment, and two stocks in particular.
Hi, this is Yong Kai here. So today we'll be featuring two companies from the U.S. oil services industry. Okay, firstly, when we talk about oil services, obviously we have to be positive on the oil price. So we think that it's unlikely to plunge back to $20+ since in the last decade. Okay, so since the start of 2010, it's traded between $80 to $110. Okay, the reasons why we think it's going to stay high is because 95% of US production marginal cost is $71. IMF also commissioned a report to say that in order to break even on state budgets, UAE, Saudi Arabia, and Iraq, these three Middle East countries, which comprise 50% of OPEC outputs, require oil prices of $75 to $100. On the demand side, we have emerging markets. There's more demand for gasoline, for plastics, which requires your crude oil. Okay, so as for we have rigs. The jackup rigs utilization has went up from 40 to 70% in the course of 3 years. What the yellow bars are the overall rig day rates. So you can see they are trending upwards as well. And some of the rigs, such as floating rigs, the fleet utilization is nearly 100%. Okay, and according to Rig Logics, 2/3 of the existing jackup rigs are more than 25 years old. So one of the companies that we're going to cover today, NOV, actually clinched 29 jackup packages in the first half this year, up from only 7 last year. So this is a very bullish replacement cycle. The oil consultant Wood Mackenzie also forecast that global deepwater drilling is going to grow 9% year-over-year for the next 10 years. Gulf of Mexico is going to grow at a similar pace, of which you have about 48 billion barrels of resources compared to only 13 billion on land and coastal US. Lastly, the success for deepwater drilling programs is going to drive demand for FPSO, which stands for floating production, storage, and offloading systems. Okay, so if you look at the number of rigs currently, there's only 47 offshore rigs in US waters compared to 1,900 mostly in land and inland waters, and also 3,500 of total rigs worldwide. So the US share of offshore market now is slightly just more than 1%. So first company we're going to cover today now is National Oilwell Varco, otherwise known as NOV. So a quick snapshot is trading at $78, which is in the middle of the 52-week range. It's $33 billion, which is pretty liquid, and it has a small yield of 1.3%. The margins are pretty decent, 12% on $20 billion revenue. The three business segments are rig technology, petroleum services and supplies, and distribution and transmission. So the NOV is actually in a very good position for the value chain because customers often specify that the drilling equipment has to come from the drill ships. So regardless whether they award the contract to Samsung, Hyundai, Sembcorp, or Keppel, sometimes they might specify that you have to use NOV drill packages, which are worth about $200 million each. So first merits, we'll look at the record backlog. So Rig Technology, what it does is a comprehensive line of highly engineered equipments. So you can imagine this covers the entire, instead of having to self-assemble, you just obtain the entire package, $200 million worth from NOV directly. 93% of this backlog is for international offshore operations, where 87% of worldwide offshore rigs are sited, where the majority are. The demand is very dependent on capital spending and overall level of drilling. So as you can see from the charts, the backlog has actually increased from $4.9 billion in second quarter 2010 over 3 years to $14 billion this year. So it's a 186% increase, which is very respectable. Margins are also improving. Okay, so previously they get more lead time to deliver their contracts, but now because of the overruns, they are actually targeting a shorter 26 to 30 months deadline states. And also there's a lot more ramp up of ongoing installation and commission jobs. Last time it used to take about 10 quarters to ramp up. Now it's like the number of jobs double in just 3 quarters. So additional costs come from all the logistics, all the deadlines, tighter deadlines, higher volumes. And so the startup costs, which there's no zero revenue attributable right now. So what NOV has done is getting more assertive on its commercial terms, on delivery schedules, on the margins as well. Operating margin used to be 29.6% 3 years ago. We feel that they should be able to boost the margins next year to 23%, which is actually on the lower end of management guidance of 23 to 24%. Just for perspective, if you get 1% more margin, you're actually getting $100 million annual operating income, which translates into additional $1 billion market cap. Remember that NOV is trading at about $33 billion, so just 1% more margin from this segment alone adds 3% more valuation. Petroleum. Alright, sorry for the disruption. So petroleum services and supplies, they have a lot of, what they offer, this, I'll generally classify them as consumables. You have drill pipes, fluids, mud pumps as well. So demand is also pretty similar to previously the rig technology. Second quarter is weaker, but you compare year over year, profits are still down 30%. Why? Because they have restructuring costs from acquisitions. You have your customers cutting expenditures as well, which actually we feel that is positive because it just translates into pent-up future sales. Remember, just bear in mind that these are all consumables. You have to replace them in some point, which is why we feel that them spending less now means that there'll be more sales upcoming in the future. If you look at the charts, actually, rig technology backlog is it has a very high correlation with the petroleum services and supplies operating income. The higher the backlog, the higher the profits, except that now we are at a record backlog, yet profits are down 30% year over year. I feel that the margins should be able to be driven higher once drilling activity picks up. Lastly, we have the distribution and transmission. You can think of it as a supply chain management. What they do is they stock and sell spare and consumables made by third parties as well as themselves. So this for them, they actually tripled the segment revenue from all the acquisitions just last year alone. This is going to increase their purchasing power. They are also in the midst of integrating 1/3 of their facilities. So these two combined with the global rollouts is going to lead to margins expansion. Today is only 4.8%, which is compared to the previous year of 7.2%. Lastly, we have the bolt-on acquisitions. So the NOV has actually acquired and integrated 138 companies since 1997. In 10 years, revenue has increased 9 times and net profits 33 times. So you might ask like, oh, what's the big deal? I'll just keep issuing stock, keep issuing debt, I can just grow my profits. The interesting thing is that out of these 138 companies, they only paid with their stock, maybe about 3 or 4 companies. Debt-wise, they have actually maintained below $1 billion for the last 10 years. This is very amazing because you must bear in mind that their market cap is the $3 billion. So having a $1 billion debt for the past 10 years, they are actually way overcapitalized and a very healthy balance sheet. This acquisition actually allowed them to consolidate the rebuilding industry. So you have your insourcing, which will help to reduce costs as well as to broaden the product portfolio. By the management's estimation, 90% of the world's oil rigs have equipment from NOV. You can't run away from it. So some risk factors is because we have record backlog doesn't translate immediately into record revenue. For third quarter, management forecasted that rig tech revenues is going to decrease slightly, but looking forward, we think they are going to have much better margins and much higher revenue. Second point, Brazil, which has given many orders to NOV. 6 out of the 7 drill ships in second quarter is actually secured from Brazil alone. It's possible that they cover capital spending, but so far we have seen no signs of it. Lastly, they have a track record of 120 companies successfully being integrated, but the recent 18 acquisitions can still be too much to digest. History is still indicative of the future. So we just do a quick valuation. So you can see what our projections for the revenues, for the margins, and we obtain at a $4 billion operating profits. So after you account for all the tax rate, like the shares, we're looking at forward EPS of 6.27. Historically, the PE has traded between 10.8 to 20.7 times. So we, to be conservative, we use a 14.5 times multiple. This is not strictly science, but we just want to obtain multiple that it's very hard to dispute, and we think that 14.5 times is a sweet spot. So we obtain a fair value of $90.92, which is 16.5% above last Friday's market price of $78, and this is a trading buy. Next, with another company, Oil States International, that we are going to feature today. The share price is $104, which is on the higher end of 52-week range. Market cap is slightly smaller, $5.8 billion. So margins is slightly smaller, 10.1% versus NOV of 12+% on $4 billion revenue. Originally, it had 4 business segments: accommodations, well site services, offshore products, and tubular services. Okay, so what's interesting about this company is that this month, they actually disposed these tubular services for $600 million cash and 9.5 times EBITDA. Accommodations is going to be spun off into a separately publicly traded company as well. Okay, lastly, what's interesting is that they have an involvement of billionaire David and Horn in the second quarter this year on the earnings conference call Q&A. So what's the merit? Accommodations. So this company, right, is unique in that accommodations provide more than half of the operating income. This is actually a real estate company hidden in the oil services industry. They own 20,000 rooms and generated $300+ million operating income in the last 12 months. For 2014, they have a committed occupancy of 67%. This is as of June 30th, so probably it has increased more. Okay, what I want to highlight to you is that the second quarter RevPAR of $108 is comparable to Marriott Hotels $112. Okay, so you might be aware that Marriott is a international MNC with many hotel operations and brands such as Ritz-Carlton and Marriott. Okay, RevPAR is calculated by using the occupancy rates times the average per night room rates. So this RevPAR is actually really adjusted for the room rates as an occupancy. What OIS does is that they have a very high RevPAR which is comparable. So we are saying that actually this is a very profitable without running your brand name hotels. Okay, so by 2015, they are exploring a possibility of REIT conversion. So they'll place a slightly higher valuation on these segments. Australia and Canada, their dividend yield is the REIT dividend yield is about 5.2, 5.4%. Okay, the only thing that we think that there might be ongoing weakness is that because more than 90% of Australia rooms serve coal miners, and Met Coal, thermal coal has seen slightly weaker prices. So this has actually led to one mine being shut down. But on the other hand, the weaker Australian currency actually improve your pricing and soften this impact. Okay, another thing is that because of the higher oil prices, the oil sand projects in Canada is going to offset this weakness in Australia. So as a quick and dirty way, if you just get the operating income of last 12 months, discount by 25%, and capitalize it at 6.5%, which is much higher than the 5.2 to 5.4% of Canadian Australian REITs, you get $3.6 billion valuation on these segments, excluding any debt. Offshore products supplies equipment for FPSO, subsea pipelines, and offshore drilling. So this is actually a competitor to the NOV Petroleum Services and Supplies. Other competitors would be more renowned companies like, say, Baker Hughes and Halliburton. Kodak background is at a 5-year high, and it has a very pretty good margins of 19% EBITDA. Management actually is forecasting a higher sequential increase of sales because of your drilling and production equipment sales that will be accelerating and higher level of service work. So for the third quarter, you are getting a 13% sequential increase to around $240 million revenue. For valuation purposes, we're going to assign 50% corporate overheads to it. Okay, this is the last segment, Wellsite Services. They own 34 land drilling rigs, but a much bigger component is completion services. So many of these big oils, major oils, and the Endako, Chesapeake, and Devon are their customers. The margins are much higher of 33%, partly because they have your rental income coming from the land drilling rigs as well. Management is optimistic that the quarter margins is going to be maintained at 32-33%. Why this is a strength? Because the OIS completion services primarily serve horizontal and completions and complex completions, and this is required by shore operations. Just a reminder, 62% of US land rigs are horizontal rigs. So what OIS completion services does is they serve the majority of these markets. You can see that from 2008 onwards, 2008 onwards, they actually have increased the annualized revenue per rig by 45%. For valuation purposes, we are going to allocate another 50% corporate overheads of $23 million to it. Okay, risk factors, because as we know, accommodation rate, what you are concerned with is higher interest rates or lower RevPAR. So given the ongoing commodity weakness in commodity, in coal prices specifically, this is quite possible. Alternatively, spin-off might not proceed as planned, because so far management has only proposed it. You still need your shareholders' approval. If it doesn't proceed as planned, it doesn't get converted into REITs, you're going to obscure the value of the other two business segments. Lastly, OIS doesn't really have the scale of the other competitors like Baker Hughes and Halliburton. Its revenue is only 1/10 the size, but its proprietary product offerings should steer it from direct price wars. More likely is that you participate in the rig building industry consolidation. Okay, so I'll just bring you to my very last slide, some of the parts valuation. So we have the 13 times multiple on offshore products, 10 times on wellsite services, and we capitalize the accommodations operating income by 6.55%. We also have the $600 million cash coming from the sales of tubular services. Okay, why they are used 10 times and 13 times EBITDA multiple? That's because tubular services, their EBITDA actually dropped 34% year over year, but they can command 9.5 times last 12 months multiple. So we think that 10 to 13 times is pretty is actually very undemanding for wellsite services which have flat revenue and offshore products which is seeing a 13% sequential increase. So we obtain a fair value of $121, which is about 15.6% above last Friday's closing price, and this is a trading buy. Okay, with that we'll open up the floor to Q&A. Okay, while waiting for questions, I'll just quickly do a quick summary on these two companies again. We are bullish on oil services industry because oil price is expected to stay high because of depleting supply and increasing demands. For these two companies, NOV is a market leader. 90% of the world's oil rigs have its parts in it. It's also a serial acquirer. It's acquired 138 companies with very little debt, and it's managed to grow net profits by 33 times in the last 10 years. So what we are optimistic is that margins reversion is going to significantly drive up their net income. For OIS, they don't have any dividends. What you are seeing now is a special situation where you have out of the 4 segments, one is sold, one is proposed to be spun off, and you have a billionaire activist that is trying to spearhead, and this market might give it recognition earlier than expected. So we are not saying that the upside is only limited to just 10+%, because for NOV, once margins is showing a healthy increase, we might give it a better, higher PE. Whereas for OIS, once the accommodations is successfully spun off, then the value might be better crystallized. Also bear in mind that the $600 million for Tubular Services, other than paying out debt, they're also intending for share buybacks. So once they does successfully execute on it, then I think we can justify a better valuation for OIS. Okay, so these two companies, right, their margins are 10+%. They are not in the exploration. What NOV and OIS are is they are the suppliers, equipment suppliers, services. They are not involved in the upstream exploration and production. So they don't own the concessions, they don't own any oil reserves in the grounds. What they do is they just simply serve companies like IPCO, companies like ExxonMobil and Varco, Chesapeake, for example. So I hope you have answered the question. So okay, the question originally was that oil and gas companies are so profitable. Why do companies such as IPCO and EMS Energy have low valuation on SGX? Okay, so I hope just now the explanation will have adequately addressed your concerns. The target price for OIS is about $121.
Hi, we have a question on the communication between Obama and the Iran president and whether this is putting downward pressure on oil prices. I think the last 2 weeks or so when we had the commodity complex come down, I think it was definitely due to the fact that there are improving ties between the US and Iran, and therefore the political risk premium has come down. But our call is basically based on improving economic fundamentals, right? So we think that is just a short temporary phenomenon, and that with improving economic fundamentals, oil will go up again.
NOV's target price is around $91, which is 16% above last Friday's closing price of $78. Thank you. Okay, we have a question on, is exploring for shale oil becoming economically viable? Does this impact future oil exploration? Okay, shale oil has been economically viable for quite a while. That's why US is actually becoming increasingly self-sufficient on oil, and the oil imports are getting lesser. That being said, the marginal cost of production is still pretty high. We're looking at around $70 to $80. So at today's oil price of about 100, 110, it is economically viable, but we wouldn't know for sure. Another thing about shale oil is that the production drops off very quickly, and so you have to keep searching for it. So it's not a case of where you do a vertical drilling and oil just keeps coming up. You have to keep doing your horizontal drilling. It's an ongoing process, and to just keep the oil flowing. Does this impact future oil exploration? I mean, real technology is always evolving. If you talk about like 10 years ago, horizontal drilling is actually not viable, but costs has been come down. They actually develop more innovative techniques. So shale oil is only going to become a bigger part. Okay, but that's also we also have to bear in mind that offshore is a different creature altogether. So the okay, let me just see how do I put it. Offshore drilling is only going to become a bigger and bigger player. Yeah, that's all I can say for now. Thanks. Sorry, may I just add that for offshore, say Gulf of Mexico, they have 48 billion barrels of oil resources, which is 4 times as much as land and inland. So this itself signifies the amount of potential. And given that deep water exploration is going to be have the same marginal cost of production as shale oil, deep water, I'll say that there are more money being spent there.
Okay, thanks for participating in the webinar. So we look forward to all of you logging in again next week. Thank you.